Okay, I thought this would be helpful in preparation for our upcoming meeting. This is a review of the income analysis, the retirement income analysis that we will be covering in our meeting. And I've gone over this with your accountant, with your CPA. So we've reviewed each one of these together in detail, and we'll go into a lot more detail in our appointment. But I thought it would be helpful for you to see some of these numbers. So this was the very first analysis that I did, where we are now including in the analysis the addition of asset class cash value life insurance. So whole life insurance converted from term insurance is now going to be included in the comparisons. So let me walk you through each of these sections. The gray section here at the top, this is our baseline. The baseline that if we take your business assets and your retirement assets, 401k, your other savings, and you never save any more money without any future contributions, and we grow that money up for the next several years, let's say 10 years, and we get into a retirement situation and we start taking distributions from it. Based on the Wall Street Monte Carlo simulation, we'll review that again in detail, but based on the Wall Street advisable withdrawal rate is about 3.6%. So if there was no additional savings, the income number from the business assets and retirement assets is $93,000. That is our baseline. Now, of course, we are going to, you are going to save. So let's look at the retirement assets, the business assets and everything with future contributions. So assuming that you maximize all of your savings, meaning that you maximize your 401k, you maximize IRA contributions, what will your retirement number look like after you save for 10 years? So that's this option here. This is saving over the course of the period of time before retirement another approximately $831,000 saved, about $83,000 a year. Saving $83,000 a year leads to a new income number, $129,000 right here, which is a $36,000 increase over the baseline. A $36,000 increase over the baseline. Okay? Now, it's important to note that is a large amount of savings for not a large move in the overall income that you can draw from these retirement assets. That if you work on the Monte Carlo simulation where you just have the retirement assets that have investment risk, you are limited by the recommended withdrawal amount, and the $831,000 that you're investing does not have the length of time to grow up to the value, for example, of your business. So that's why the impact of so much savings is not as significant as you might imagine. Now, when we add in the life insurance as a balance to your retirement assets, we call this the covered option here in the blue. This is the covered option, and when we add that life insurance, you are then able to pick up and choose, if you want, to get a personal pension. A personal pension allows you to increase your income to $200,000 a year. So now we've moved the needle from $129,000 to $200,000, and there's a very important thing to notice here. Of the $200,000 in this one, $138,000 of that income is a completely guaranteed personal pension. Guaranteed, which is actually $9,000 higher than the non-guaranteed option from the Monte Carlo simulation. So let's keep going. In the green section here, this is where you stay in the market, and we call this the buffer option, where we use the life insurance cash value as a buffer to take our income after down years in the market. If we do that, we're not guaranteeing our income, but we're giving ourselves much more security and still able to pull in nearly $200,000 a year consistently with just about 3.5 years of buffer. And again, we'll review all these options together when we meet, but this is my first analysis. So let's keep in mind our maximum income target now is $200,000, and that only happens because we have the life insurance included as a balance against the retirement assets. So let's take a look at the next one. We've got another. You can see we've got our baseline at the top. You can see that we have our retirement assets only. We're still at $129,000, but notice what's happened here in the personal pension. The personal pension option now has moved up by an additional $26,000. We now have $133,000 over our baseline. And we still have a pretty substantial option here if we want to stay invested in the market after retirement. So that led to the next one. As I analyzed this and realized that's a substantial increase by increasing the amount of life insurance leveraging, the balance of life insurance coverage on Patty, what would it look like if we put a maximum number on both? What would it look like if we increase the number for both? So of course our baseline, of course we've got our retirement assets. This is our guaranteed option, and this is our market option. So we've got our 129 from our Wall Street choice that if we don't use the life insurance at all, so we get into retirement and we have no life insurance to balance your decision for how you draw income, you are subject to the Wall Street Monte Carlo simulation, and you've got to be very careful with how you draw it out. That's why that number is so low. When we look at the guaranteed option, the number is now moved to $238,000 with $204,000 of that completely guaranteed, a $145,000 increase over the baseline. And still a $237,000 number if we want to stay invested in the market. We've got a fantastic balance there as well. So we will review these numbers in much more detail together so you can see where these come from. And your CPA had actually also suggested that we look at a fourth option that I will prepare when we get together. I hope this is helpful. I look forward to seeing you soon.